Hey, good morning, everybody. It is Thursday, February 5th, 2026. I, of course, am Hammer, founder of Originator Success, Grab and Go Social, and Rate Sensei. Three different, distinct, unique, self contained products from me that help mortgage originators build their brand online with Originator Success, help them to be found and get business from social with Grab and Go Social, and help you with the rate stuff with Rate Sensei. Thank you for joining me this morning. I do this each and every day at 9:30 a.m. Eastern Time. You're welcome to join me as I go live and talk about what's going on with the markets, what we've got going on with rates and pricing. If you are here this morning, say good morning. If you're watching the replay, just give me hashtag replay in the comments. Let me know that you were here. If you would like a quick reminder that I'm going live, I do send out a text alert as I'm going live. It's absolutely free. Send you the links so you don't ever miss a moment of the show. Check us out. Go ahead and sign up for that reminder, hmmr.io/reminder, or use the cool QR code that is on the screen. If you're on your phone right now, take a screenshot, go back to your photos. You can press and hold that QR code and they work. QR codes were useless for years, but they're so much easier now that the phones have actually incorporated them into the software. Also, I do a daily email. If you would like a quick read, we do an email about what's going on in the markets and what you should do with your loans. Check that out. Sign up at ratelockadvice.com. You can also sign up for our text alerts at www.ratetextalerts.com. And that's all we're going to talk about right now. So if you're here this morning, say good morning. So happy to have all of you here. Thank you again for joining me. Don't forget, smash that like button. If you're on YouTube, give it a thumbs up. And if you're on Facebook, do the same. And, just go ahead and help us with the algorithm. Give us a little love. Appreciate you doing that. Let's go ahead and welcome all the live folks. Say good morning. Nicole Semerada and Mallory Fotiadis, good morning. We've got Eric McDonald, Holly Johnson, Rob Stewart, Tim Klyla, Amy Blauser, and Zane. Good morning, y'all. Mike Brown, Angela Walters, Kenny Rivard. Great to see you here. I am back in my wooden wall-covered walls here in the barn back at home. Got back late last night. Good morning, Ron Siegel. He said, today we celebrate National Chocolate Fondue Day. And since this is a family show, he won't mention it as National Shower with a Friend Day as well. I think it should be. That's funny. As we redo the bathroom for my son and daughter-in-law, that was one of the things that came up is to make sure there was enough room so they could shower together. Vicky McSweeney, good morning. Tiffany Teal, Fayez Gravano, Kathy Jensen, Mike Tebow in Florida. Thanks for joining, Mike from Florida. Hope you're enjoying the weather. I'm sure it's much warmer than Michigan. How long have you been down there and how long are you staying? Just curious. Let me know in the comments. Deb Dickinson, good morning. All right, y'all. Well, let's go ahead and get started. We'll jump out. In case you didn't know, what we're going to do is we're going to look at the technicals this morning, talk about what is coming out. We've got some interesting things. Some of the data that did not get released this week is being released next week. So we'll go into all of that and show you all of that as well. But let's go ahead and start off first. We'll show you the technicals. Let me bring up Presentify. So there we go. All right. So taking a look this morning, bonds getting a bit of a boost early in the day. We're up 12 basis points. The reason that we're up 12 basis points is that bonds have enjoyed the jobs data that's come out so far. So we'll talk about that in a minute. There was actually a couple different reports that have hit. And we got one more coming out in about 20 minutes. But mortgage bonds up about 11 basis points, 12 basis points on the day. You'll see that is better than when pricing came out yesterday, right about here. When pricing came out, right around 10 a.m. generally is when pricing comes out. Bonds were around 99.75-ish, 99.80, right here in this window. And today they're at 99.84. So we're up, anywhere from 5 to 10 basis points up here. We're going to get the jobs data. I'm sorry, the JOLTS, Job Opening Labor Turnover Survey. We're going to get that data right at 10 a.m. So that's, as lenders are coming out with pricing, we may see these bonds even improve a little bit further if that shows the same kind of labor market weakness that was seen in the Challenger jobs report this morning and jobless claims, unemployment claims. So if that were to move up a little bit higher this morning, you could see even slightly better pricing. But looking at the window of where pricing really is, and let me just move this over like this so we can bring you guys in. Give me a second here there we go. All right. So taking a look at where that actually puts us as far as pricing. Yesterday, we were right at the same pricing as basically the day before. So 6.20. And remember, that's right where we've been. We'll call it that low sixes, right? Say 6.25. That's where we were as we headed into January. 6.20, 6.21, 6.19. We're right back where we were at the beginning of January. We did have that little bit of a bubble here. Right here where Trump posted about having the GSEs buy $200 billion in mortgage bonds, mortgage rates, of course, responding to the market reaction that helped mortgage-backed securities improve. I got to refresh this so it'll scroll. Here we go. Remember, that was right here these 2 days. But since then, we're back where we were. Now, one thing to note, though, is look at the dates on these. We got Friday the 9th, Thursday the 8th. And back at that same time, the 10-year was, here we go. Look at how much better the 10-year was. 4.17 was here during that time. And right before that was 4.16, 4.18. So the 10-year is a lot worse. So in all fairness, we do have to say, even though we're seeing rate sheets that are very much the same as what we were, according to what we've seen with the 10-year Treasury, if spreads didn't stay improved like they have after that announcement, we would be seeing rate sheets that were about 1/8 of a point higher. We'd be at the worst rates of the year. So we are still seeing some benefits from that. I should be fair and put that out there, even though, again, it doesn't necessarily translate to pushing rates down permanently. Things still going to cause them to creep back up. So anyway, this morning, you take a look here. And, quick recap of what happened yesterday. We can see that mortgage-backed securities, like I said, they came out around 10 a.m. They improved a little bit through the early afternoon and then gave it all back. Ended the day quite a bit worse. Not enough to trigger reprices worse. Did anybody see any reprices worse? I didn't really see anything there. But it was still quite a bit worse. But not enough that we were going to panic. Even in the end of day text, I said, not really much to worry about. This morning, we got this bump right here, though, and that's why rate sheets today will be either, they should basically be a little bit better than yesterday. Not tremendously better, but at least a little bit better. Reprice risk on the day is low. There's not much we have to worry about. So this morning, we had the Challenger jobs data first. Let's see, which one was, here it is. So U.S. companies announced most job cuts for any January since 2009. So this is the Challenger job report, basically. So U.S. companies announced the largest number of job cuts for any January since the depths of the Great Recession in 2009. According to data from outplacement firm Challenger Gray and Christmas Inc. So that's why they call it the Challenger Report. Companies last month announced 435,000 job cuts, over 118% increase from a year earlier. The report on Thursday also showed hiring intentions slid 13% from a year earlier, making the weakest total for any January in the firm's records back to 2009. Now, you'll remember, as Ron Siegel likes to point out, the Fed, looking back, the Fed at their just last policy statement from their meeting last week said that they think that employment is stabilizing. This would point to something much worse than stabilizing. And that's why markets reacted to it the way that they did. You can see it here in mortgage-backed securities. Let me bump this up. Bear with me and I'll get that. Okay. Excuse me. You can see that here, and the reaction that we've got right here, this initial increase in pre-market trading. Remember, that came out at 7:30 a.m. Eastern time, so that's why we saw that big market move. And then we also got jobless claims. Jobless claims increased more than expected. You could blame that on the weather and the cold snap. A lot of people will blame it on that. Remember, week-to-week job claims can be fickle, but number of Americans filing new applications for unemployment benefits increased more than expected, likely boosted by snowstorms. Told you that they'd blame that across much of the country, but labor market conditions remain stable. Initial claims for state unemployment benefits jumped 22,000 to 231,000. Remember, we used to say anything below 300,000 was a strong labor market, and we have been in the low 200s on these for quite a while. But we're still looking for any signs of weakness. And that's why I know I'm a Fed fanboy, but that's why the Fed is not really all that triggered by the jobs data, because we used to say we've been coming in the 200,000s for years, and this is on the low end of that. So it's not much that everybody is really panicking over. Same thing in Bloomberg. Basically, could have just written the same article, same numbers, and that it was due to the snow, right? Continuing claims increased to 1.8 million the previous week. That's worth watching because it shows how many people remain on the unemployment payroll. Now, there's an argument that a lot of people are not on unemployment because of immigration issues and being deported and different things. That's where markets are also pricing some of that in. Now, at 10 a.m., we're going to get the job opening and labor turnover survey data. That's going to come out here. You'll see we have it up on Thursday the 5th today. That's going to come out at 10 a.m. So we will see that. That's going to be in about 15 minutes, and it could help things improve a little bit more. We'll see. Next week, we're getting the jobs data we should have had. So tomorrow we should have gotten the BLS, non-farm payroll, wages, and unemployment numbers. That's going to come out here. It's called the employment situation, is what the BLS calls it. The employment situation going to come out on the 11th. So next Wednesday, we get the jobs data. We were going to get the consumer price index inflation data on Wednesday. That's what was originally scheduled for Wednesday. That has been pushed back and will be coming out on Friday. So next week, going to be a busy week, and we're going to see jobs data and inflation data. So if we see cooler inflation, if we see softening jobs, we could see better rate sheets. Keep that in mind. So even for loans closing near term, I'm still saying to lock because I don't know. I mean, we could see some negative here, but there's an argument to be made that you could even float those loans, especially if they're closing sometime the week of the 16th. Remember, the 16th is Washington's birthday / President's Day. So we got that going on as well. And of course, very important, Hammer will be snowmobiling. He will be leaving on Thursday the 12th, and he will not be returning to the office till Wednesday morning. So Hammer will be out these days snowmobiling, but I will still be on there live. Ron Siegel says, irrational move in the 10-year Treasury. Treasury Department says issuance the next couple of quarters will remain as forecast, but there might be additional issuance needed later. Yes, in 2027, they said they got to love it. Again, we're trading on news for what could happen in 2027. They're saying they may need to issue more Treasuries in 2027. What does that later mean? No amount of additional issuance suggested. Why did the market move? When you say the 10-year, I mean, the 10-year, how much did it really move, though? You're at 4.248, so 4.25. We were at 4.28, 4.27. I mean, so yeah, Ron, I know what you're saying, that this did arguably improve a little bit, but I don't think there was a tremendous reaction to that yet. I think it's too far out as well, saying in 2027. Looking at looking at mortgage-backed securities, and then we'll look to wrap up. Not as much to talk about today, but looking here, we are playing in the technicals, right? We are playing in the technicals here. So we're staying between the 50-day moving average, this red line, and the 100-day moving average, this green line. We've pushed above it for today, which is a good sign, but it may not hold, and if it doesn't, there's nothing for us to panic about. But yesterday, bonds ended the day 99.72, currently up 99.82. You got that 10 basis points here. It jumps you above that red line. Again, nothing to get super excited about, but rates are going to stay very much where they're at. We've just, we've said this over and over and over. You're going to see days where you're pricing at 6.20 and days where you're pricing at 6.16. You want to get the better rebate when you can. And that's really all we're looking for. It's very unlikely we're going to see rates move much. My advice remains very much the way that it has been. I would lock anything closing in 15 days because there's not enough improvement here to get excited about. That's just my take on it. Next week with the jobs data and the CPI data, probably tomorrow, maybe I'll switch to a floating position, or early in the week next week. So do with that as you may. If you wanted to float it there, if you want to gamble it, we could see improvement if that jobs data does come in weak, if that CPI data comes in cool, that could push rates back down. We could be back at like 6.10. You could see a nice bump in rebate there. So keep that in mind. Good morning, Patrick Campbell, Rob Wilson, Jerry Avila. Great to see all of you. Will Patterson, great to have you here. So that's kind of what we've got going on tomorrow. I don't think there's anything on the economic calendar. Let me make this full screen for a minute. We'll pull up the economic calendar. Hold on, and we'll take a look and see. I don't think there's anything of merit tomorrow. We've got consumer sentiment. That's going to be, I guess like the biggest. Oh, I'm sorry, you guys can't see this. Let me pull this over. We do. Here you go. So tomorrow we got consumer sentiment at 10 a.m. That's the only kind of market affecting, and it's not going to be a big mover, but it could help a little bit. So there's no urgency for loans closing late in February or into March, though. I would be floating those. It's just loans to close near term. I don't trust that we don't see anything pop up, but really there's nothing else in the headlines that we have to get scared about or worry about or anything else about. So it's nice and quiet as we look at this stuff here. I mean, it's a very calm headline. Look at that. Hims and Hers Health launches compounded copy of Wegovy pill at $49. They are absolutely breaking it up for the health stuff, but not our area of expertise, but definitely something y'all should look into more here. But anything else that I see really matters? No, I mean it's quiet. There's really not anything that we think we're going to see anything big movement. So keep that in mind. Tony said, is Tony Bevacqua. Anyone else seeing the screen frozen? I don't think so. Does anyone else see the screen frozen? Everything's working for me. I see cat hair on my mic. While I was gone, they must have been used. Maybe they were going live. I'll have to clean that off. So anyway, that's it, my friends. I'm going to go ahead and wrap it up. Again, tomorrow going to be a quiet day. Not as much to talk about, but I do hope you'll join me. Also, don't forget, if you are looking to grow your business, go check out Grab and Go Social. It's our answer to giving you content to post on a regular basis, as well as coaching and community. The 3 C's you need to win on social media: content, coaching, community. We've got pre-made content that you can customize on the fly with programs like Canva. Don't depend on shitty AI stuff. There is good AI. We'll give you some of that, but don't depend on shitty AI stuff. You need some stuff that's going to hit, help you. Main thing is consistency. I just came back from my Founders Board meeting, and Founders Board is a group of business owners outside the mortgage space. And I ran a topic table about how I do my lives every day and I do my emails every day. And, consistency is the key. If you're going to build your brand and get business online, stay in touch with clients, stay in front of real estate partners, you can do that with social. Check out Grab and Go Social to help you with that, grabandgosocial.com, or use the school QR code over there. Vic McSweeney, you still give me a thumbs up. Thank you. Y'all said it's freezing. I wonder why. I don't know. Freezing on YouTube. I'll have to check my let's see. Yes, YouTube on computer and cell both have frozen screens. All right, well, I'm going to wrap it up then. Take care, everybody. Have a fantastic day. Bye-bye.